Hi, this is Greg Ehrs, and we're back with our guest today, Steve Hotovec, founder of Barristone Inc., a interesting company that we're going to learn a little bit more about because it is one of the solutions that we would like to share with our viewers with respect to the problems that they're facing due to higher interest rates, higher levels of debt. Steve, welcome back to the show.
Thanks, Greg.
Steve, why don't we let's get into your solution here. Let's understand what your solution is. If you can, give us a high level but easy for our viewers to understand what a home equity sharing agreement actually is and what it accomplishes, and most importantly, do they qualify? Because we talked about before high DTIs, high usage, etc. So if you could just kind of get into that, and I'll probably jump in with a few questions, but we're
Sure.
interested to hear this.
Great. Thanks, Greg. Yeah, I call this, we've been doing this for about a decade now. I call it the 10-year overnight success story. So the roots in this product, and earlier on, they were called a couple different things. Like you mentioned, they were called equity sharing. They were called real estate participation agreements. Kind of fast forward over the last decade, as these products have started to take hold, they're now referred to as home equity investments or home equity agreements, HEIs or HEAs. And one of the best ways to just get the uninitiated familiar of what these are is to describe what they are not. So they're not a loan, they're not a line of credit, and they're not a reverse mortgage. They are an equity-based solution for homeowners. So that means that the homeowner is able to basically access trapped home equity without having to without having to qualify for a loan, without having to make monthly interest payments, okay, and without incurring the burden of additional debt.
Do they pay their mortgage still, Steve?
So they always have to pay their mortgage. These products normally are in a second lien position, meaning that they'll have a mortgage and then they'll use a home equity investment or a home equity agreement to supplement or to access that trapped equity that so many people are having difficulty accessing now.
And you said there's no monthly payments. Kind of explain that. How is this into forever? I mean, when do I have to pay it back?
Yeah, so it's well, a lot of people say, "Oh, this sounds too good to be true." It's not free money. It's basically think of it as an equity advance. Okay, so the homeowner, we like to say that household wealth begins with the home, and as we mentioned a little bit earlier, a lot of homeowners now are sitting on a large amount of equity, but home equity is a non-financial asset, meaning you can't take it down and use it to buy goods and services. And so what a home equity agreement does is these contracts between the homeowner and an institutional investor, they basically will advance a payment. It normally is anywhere between 10 to 20% of the home's value in exchange for sharing in a future value of a percentage of the home. Some of the contracts last for 10 years, some can last as long as 30 years. And so it's a lump chunk payment that the homeowner receives in exchange for sharing a percentage of future value in the property.
So when you call it an equity agreement, does that mean it's if I have a credit score, I'm a bit impaired, like we kind of described in the first block, Steve. My credit score, I don't know, let's say 630. So I don't qualify. I think you said 680 to above 700 for a HELOC. Do I qualify for a home equity investment?
Provided that there's enough equity in your home, the answer is yes. So because it's based on the amount that you have, and I like to say that it's not based on your ability to repay, it's based on your ability to stay in the home, which means that you need to make your mortgage payments, you need to keep your insurance, but that chunk of equity that you have, the investor is going to advance you a cash payment. You're going to agree to share in a certain percentage of that value in the home. And what you're going to do is, more often than not, you're probably going to pay off that credit card debt. And a lot of people will use this to improve their credit, lower their debt to income, kind of get themselves back onto better footing financially.
So it sounds like you're offering lifeline to people that want to change their financial behavior, right? If my
Correct.
credit score is 630 or 640, and my utilization or my DTI are bad numbers, and I can't go to a traditional lending institution, or my income doesn't allow it. You're giving me the ability, because you said this is not a debt instrument, this is an equity investment. So that means it wouldn't affect my credit score. So if I was actually lowering my debt outstanding, my credit score is going to go up, because the credit agencies don't see this as debt. Is that the way to look at it, Steve?
That's correct. It will normally it has a positive impact on your credit score, because normally folks will improve their credit score because they're going to pay off that expensive debt, but it does not report as a loan. Okay, so if you get $100,000, it allows homeowners or households to, as you said, a lifeline. I call it a course correct. It allows them to actually get things back into balance where they're not so debt laden.
Right. And now, this is for a homeowner. I've got 3 rental properties. Can I do one of these on one of my rental properties if I've got equity, because I might want to expand my portfolio? How
Sure.
can what are some of the ways these are being used, and what's the limit?
Yeah, that's a great question. We get asked that quite a bit. So these can be used for owner occupied, meaning your primary residence, and they can also be used for non-owner occupied. And I like to tell people that it really is for the kind of a slice of America, right? It's really homes, condos, townhomes. Um, it's not used for commercial buildings. It's not used for like giant apartment complexes, but for homeowners and rental property owners, it's often used as a instead of using debt. Let's say that you wanted to buy an additional condo and you couldn't qualify, right? You might use equity in combination with lending in order to have a solution. So it's a very, very powerful tool, for owner occupied properties as well as rental owners.
Yeah. Now, Steve, you mentioned earlier that you've been at this for about a decade. Um, Talk about the product itself. I mean, it sounds interesting. It sounds like it solves a lot of problems, but yet at the same time, it really doesn't sound like it's that well known across the country. I mean, tell us a little bit about where this product kind of falls. What are your challenges in terms of building a business like this with respect to the consumer? And are you seeing things change?
Sure, that's a great. I think you never understand. What is hindsight's always 2020, right? So in looking back, and you look at all the different steps and all the things that we take for granted in this country as mortgages. Okay, we have a very efficient mortgage business, as you know. When something new comes out that's not a mortgage, that doesn't fit in the box, it's kind of all the infrastructure. It's hard for people to get their minds around how does this work? I've never heard of this before. Yet when we look at the commercial lending business, there's mezzanine finance and there's equity buyers and there's also debt providers. So if you look at this industry maybe was doing $50 million a year, which is nothing to where it is today. It's probably about $250 million of origination per month. There's about 6 different companies. There will be more players. And probably the most notable is that in the last year, starting in 2024, there have been securitizations. And what securitization means that these are packaged and then they are sold to insurance companies, et cetera. And this is really going to grease the wheels and get things moving much faster. You will see this become more and more mainstream. Because it is a real estate product, it is very adjacent to the mortgage industry. It is very complementary of the mortgage industry. And I think you're going to see more people incorporating equity-based solutions along with just traditional debt products.
Do I'm in a bad situation, but I qualify for one of these, and you give me the money that I need. Can I pay you back in a year? Can I pay you back in 6 months? how does it work? And then what happens if it gets to whatever the length of the contract is? I think you said 10 years. What happens if it gets to the end and I don't have the money?
Yeah. So so using your example on a 10-year product, the advance, there's no debt service. It doesn't report on your credit. You need to maintain your mortgage payments. You need to keep proper insurance on the property. So kind of fast forward, depending on the homeowner maintains all rights and privileges of the property, meaning that you can pay this off at any time. At the end, the contract ends when one of the following happens: when either the last surviving homeowner, passes, when the term is up, in the case of a 10-year agreement, or if there's an event of default. So an event of default can be you didn't make your mortgage payment, then the investor actually would have the ability to foreclose. They're basically no different than a loan, but it's not a loan, right? They would actually step in. It has the same privileges and securities that a loan does, but you do not have to make the interest payment. You brought up the question: what happens if the homeowner does not have, in 10 years, they either have to refinance. Okay, they will have to, and a lot of people might go and do a reverse mortgage. They might do a consolidate. They might even roll it into another HEI or home equity investment, or they'll need to sell the property. But it is due at the 10-year. They'll need to take that one of those steps.
But if I sell the house, do I still owe you money, or does it end when I sell my house?
When the property is sold, the agreement, just like the loan that you have, if you have a loan, that'll have to be paid off, and the home equity agreement will need to be settled when you sell the home.
Got it. That's great. Well, that's a great way to close out this segment, Steve. Like to have you back for the next block and spend a little bit more time on home equity investments. Steve, thank you very much, and we'll be back after we hear from our sponsors.
Great.
You
Thanks,
break
Greg.
past limitations and rethink success. Are you ready to push the boundaries of what's possible?